Over the last 12 months, we've been treated to a parade of CEOs on trial. From WorldCom to Enron to HealthSouth to Tyco, these chief executives have all taken more or less the same position. Bad things may have happened on our watch, but we didn't know it, so we don't bear any responsibility. Really? I'm Sarah Bartlett, and this is our topic today on USA Inc. Joining us today is Larry Zicklin, the former CEO and later chairman of the board of the investment firm Neuberger Berman, who teaches business ethics at New York University and Wharton and is chairman of the Baruch College Fund. Larry, thank you for being with us today.
Thank you, Sarah.
You're watching these trials of the CEOs that we've seen over the last few months. What do you observe as you read about them?
I'm absolutely shocked by some of these trials. First of all, I'm shocked by the human condition in the sense that some of these CEOs, I think, actually believe what they're saying. I may not believe it, but they believe it. I'm also shocked by the difficulties juries are having in reaching a decision. They had a difficult time in the Bernie Ebbers case. If you remember, before they convicted him, they went many days of discussion. And then only on the final day, as I recall, did 4 jurors finally change their mind. But before that, it was an 8-4 split. So you had the risk that Bernie Ebbers could have been actually found innocent of all this stuff. And now you're getting it in this Scrushy trial where
with HealthSouth,
the jury increasingly looks like it could be a hung jury. And you're going to get it in the Kozlowski-Swartz trial. We'll see where that jury comes out. But to me, they're all easy.
What makes them so easy for you?
For me, they're easy because they all involve fraud. They all involve manipulation of the numbers. They all involve cooking the books. Many of them involve, and I'm thinking now of Kozlowski-Swartz, money leaving the company and finding their way into their pocketbooks, and nobody seems to have authorized it. When you ask, the only person that they say authorized it was one director, who unfortunately is now dead, but the other directors don't remember it. And if you notice, both Swartz and Kozlowski forgot to include $25 million of that compensation in their IRS returns. So it seems so simple when you see it. I don't believe companies can misstate billions of dollars of earnings, and CEOs don't know.
Now, let's go back to your initial point that they seem to believe what they're saying. They say, this wasn't my responsibility. I'm not skilled in the accounting. I didn't know what was going on. It was hidden from me by my underlings. Why is that not a reasonable defense?
Let's take the case of Scrushy at HealthSouth. He was the CEO. He's really the creator of HealthSouth. He made HealthSouth into this multi-billion-dollar company. Scrushy has already had 14 or 15 people plead guilty to fraud. Other people are still going to be tried. Scrushy had 5 chief financial officers plead guilty, all of whom he hired. Now, I've heard of carelessness, but that goes beyond the pale of carelessness. All 5 CFOs have said that Scrushy was knowledgeable. The only thing you don't find is the written record. You don't find the emails, you don't find the notes, you don't find telephone records of it, and that's because CEOs are very careful to avoid all that. I often tell my class, if your boss tells you to do something wrong, be careful and don't do it, because when the time comes, you're brought up on charges, he or she won't remember that they ever told you that. In fact, they will deny it. So you don't do things like that. In fact, just as an aside, I once had a Navy captain in my class, and my Navy captain taught me a lesson I will never forget. He said in the Navy they have a saying, you never want to be the highest ranking officer with a secret. You pass it up.
Uh-huh.
And I tell that to my students.
Well,
don't be the highest ranking officer with a secret.
But if this is so straightforward and so clear, why is the legal system not being able to bring convictions?
Well, they did get Ebbers. It remains to be seen if they get the others. Remember, you have to show intent. And defining somebody's state of mind as to knowledge of this is not so simple to do. It may seem obvious that a fellow like Scrushy with 5 CFOs that have pleaded guilty, 10 others that have pleaded guilty, massive restatement of earnings, massive cooking of the books. It's so obvious that he had to know. But I would go further. For me, it's the U.S. justice system. And it works, and so you have to applaud it. But people find it difficulty to find others guilty of something without absolute and direct evidence. And sometimes, if you're bright enough, CEOs can be careful and avoid that direct evidence.
Would you recommend seeing some changes? I mean, are there things afoot that you would like to see encouraged?
I believe that there's a lot of what is called deliberate indifference. People don't know and don't want to know. And people who do know pretend they don't know. And to me, the change that ought to take place is one in which CEOs, and I would include board members in this also, would have no defense in the event of massive fraud, deliberate misstatements, material omissions, unless they did due diligence. I'm there. Somebody can be fooled. I understand that a CEO can be fooled by people within his company. But if the CEO never talks to the accountants, never talks to the internal auditors, never reviews the financial statements, never has anything to do with any of the internal controls, that CEO should have no defense. You should show some initiative on your own. I liken it to a registration statement that's filed on behalf of companies that are selling new securities. When you do that, if there is an omission or a deliberate misstatement, or any misstatement for that matter, the company is automatically guilty. It's strict liability, and it doesn't matter why. Guilty. And anyone who signed the registration statement is guilty unless they can prove that they performed due diligence with regard to that statement. Did they talk to the accountants? Did they review the numbers? Did they ask questions? Did they talk to internal audit? What did they do to assure themselves that the numbers were correct? But if you did nothing, I believe there should be no defense.
So you would start to treat individuals then the same way that you treat corporations?
Absolutely.
In this,
but the one difference is the corporation, when there's a fraud on a registration statement, they have no defense, no due diligence. But the individuals within the corporation have the due diligence defense. And I would certainly give people the due diligence defense as CEOs. After all, what's the difference if you sell securities and you market it, and when you prepare an annual report, an annual statement, and a proxy, the statements are the same. They're being relied on by investors and creditors. Why shouldn't you be subject to the same penalties?
But how do you protect the CEO who does a reasonable amount of due diligence? And of course, reasonable is a vague word. And there is someone underneath that CEO who, for whatever reason, has decided to cook the books. How does that CEO get the full protections that someone deserves?
And my answer is, if you did the due diligence, you should be absolutely protected. I understand that the CEO can't be anywhere. In a large corporation, he can't be in 40 countries around the world. He can't be supervising all the accounting entries. I appreciate that. But you should know enough to ask questions. For example, this was a poor year for us. How come our earnings are up 20%? I'm reminded of the Bethany McLean article in Fortune magazine in March of 2001. She wrote an article which I happened to read, and I had no interest in Enron at the time. But she wrote an article called, "Is Enron Overpriced?" And here was this wonderful, articulate Fortune magazine reporter asking the question, how come this company sells at such a high price when it has no profit margins, no cash flow, is borrowing more money every single year, has a business nobody understands? And she actually articulated that in the article by going to visit some of the people who follow the company who couldn't explain where the earnings came from. That's a perfectly reasonable question to ask. You don't have to be a CPA to ask that question. She did. Why didn't the people at Enron ask that question?
Well, what do you think? Do you think that the Enron trials are going to revolve around these same issues where the C is going to say, I didn't know, I had no idea?
Ken Lay is going to say, I didn't know, I'm not an accountant, how can I know what's going on? But if you go back 3, 4, 5 years, you'll find his picture on the covers of magazines, on the front pages of magazines, in the newspapers, being called the great new manager. He was talked about as being Secretary of the Treasury. At one point, CEOs know everything. And then when it goes wrong, they didn't know a thing, which obviously leads to another question. How come for people who don't know anything, they get paid so much?
Well, I was about to ask you the same question.
I mean, they get paid, Ken Lay, they say, walked away with $240 million. For what? He didn't know anything.
Well, it goes to the heart of the relationship between risk and reward in this country, and that's been broken because people are protected on the downside but get to enjoy all the upside.
And it goes to the relationship between CEOs and boards protecting them. Now, the Enron board was a perfectly reasonable board, but they weren't reading the material. There's a sense on boards that I don't understand what's going on here, but I'm sure somebody else does, and I'm too embarrassed to ask. I always remember at our firm, one day, Roy Neuberger, bless him, he's going to be 102 in July. Wow. Roy stood up at a meeting we were all at and started to walk out, and somebody was kidding him and said, this is a little too deep for you? And Roy said, just because I haven't the vaguest idea what's going on in this room does not make that stock attractive. And he walked right out of the room.
But seriously, don't a lot of the issues that we've just been talking about with CEOs relate to directors too? Would you apply those same standards
Absolutely.
of due diligence?
Absolutely. Every director is required to sign the financial statement. I would absolutely apply it. Did the head of the audit committee ask the question? Did they interview the accountants? Now with Sarbanes, it makes it a little easier. But the Enron board, good people, bright people, some of whom lost a lot of money in this transaction, showed no interest in any of this.
Should they have, are they liable legally, in your mind?
I don't know that they're liable legally because I don't know what actions they took. Did they sell stock? Did they not sell stock? I suspect they could have a problem. I would point out that the WorldCom board, and I think some of the members of the Enron board, now that I think about it, settled some of these suits with money out of their own pocket. That's a first. We haven't seen directors put their hands in their pocket. So you're seeing the beginnings of that. But the Enron board, I would consider part of this deliberate indifference. They just didn't look. They must have read Bethany McLean's article. You would think they read the article and they asked the question. Why did they let Gary Fastow trade all day and all night with Enron, make $40 million trading against the firm he was the CFO of, and they never asked the question? I wonder how he's doing on his end.
On that note, we'll be right back.
The Zicklin School of Business at Baruch College of the City University of New York is the largest and most diverse accredited business school in the United States, offering high-quality, full-time and part-time degree programs at the undergraduate, master's, and PhD levels. For information about the Zicklin School of Business, please visit our website, zicklin.baruch.cuny.edu. That's zicklin.baruch.cuny.edu.
Welcome back. I'm speaking with Larry Zicklin, former chairman of the board of the investment firm Neuberger Berman. Larry, tell us about Sarbanes-Oxley and how this has changed the whole landscape. Is there an improvement?
I think there's an enormous improvement, but I think the biggest improvement is not so much dependent on the rules and regulations of Sarbanes. I think those are all fine. There's some problems with them. We'll iron them out over time. I don't think that's the real improvement. The real improvement, I think, is the psychology of directors and officers. They are now more focused than they've ever been. When you know that Sarbanes is sitting behind you and there are penalties, it tends to focus the mind on the job at hand. I think they're much more responsible now. You've seen audit committees that meet not only quarterly when the boards meet, or whatever, 6 times a year when boards meet, but they're meeting all the time. They're talking to the auditors. They're ironing out the problems. They're disclosing some of the problems to the rest of the members of the board. So I think that's an enormous plus. Nominating committees. So you make sure boards aren't in the hands of the CEOs. After all, a lot of this has taken place because there was a lot of hand-washing going on. The CEOs take care of the board, and the board takes care of the CEOs, and the shareholders suffer. Well, that's no one way to run a business. That wasn't the intention. So I think you're seeing nominating committees come into their own. You've got governance committees coming into their own. I think all of this works well, and I think it's based on psychology more than rules.
Now, we've seen some news recently that William Donaldson is going to be leaving the Securities and Exchange Commission, and there's some people who feel that he was being very aggressive down there and trying to make sure that those rules were applied and held firm, and he resisted efforts to sort of dilute them. Do you see a change coming given that he's now leaving?
Unfortunately, I think there probably will be. I think Bill Donaldson was really a credit to that job. He was a very dedicated, decent, hardworking, energetic man. And while I don't know him personally, I have nothing but the greatest respect for what he did. I would hope that the new nominee doesn't do that, but I suspect he will. The one place where people are saying that Sarbanes might have gone overboard, and that might be right, is on the internal controls issue, what is called the Section 404. And I assume that can be handled and made more reasonable for business. But I wouldn't fool with Sarbanes a whole lot. Sarbanes is working.
There are a number of other issues that are on the table in terms of hedge fund registration and also being able to nominate directors, shareholders having that capability, and that he was backing some of those issues, and now, with his departure, will that weaken?
It's certainly
those
going to weaken
efforts?
the nomination of directors. Look, we haven't found a real methodology for shareholders to be involved in the selection of board members. I don't know of a great way to do that. I would love to see institutions become more active. But one of the problems you have in this business, and maybe this is getting more detail than you want to get, but who is a shareholder? If I'm an arbitrageur and I'm buying a stock for a certain reason, and I buy 1 million shares of that stock at that moment, and I hedge it off somewhere else so that I have really no ownership, but I can vote the shares I have, am I a shareholder or not?
What do you think?
I don't think you are.
Because you're not voting the shares?
No, because I have no real interest in the company. No matter what happens, I'm going to be out of this stock. Or if there's a merger, I'm going to be out the next morning no matter what. Am I a real shareholder? I don't think so. I think some of the large mutual funds, pension funds, they are really shareholders. But we haven't found the methodology. And yet I fault institutional investors because I think they've been absolutely indifferent to their responsibilities to their own shareholders. I think mutual funds have an obligation to the people who invest with them to be active in corporations. These things shouldn't have happened and wouldn't have happened if more institutions had been active.
Yeah, I think the blame can be almost equally shared between the world of the CEOs, the world of the directors, and the world of the shareholders who have not been, generally speaking, very active. What about the ones who have been active? Have they been active in the right way? Some of the state pension funds.
I think the state pension funds have been fine. I think some of the other funds have been active only to achieve a certain goal. What I'm thinking of now is the takeover, I guess it would be a merger, where Quest and
MCI.
I guess it was Verizon. Were trying to take over MCI. And a lot of reasonably small holders championed the Quest effort. The Quest effort was a little more, I guess, profitable to them. The price was slightly higher. But Quest had no business taking it over. It had no long-term prospects to talk about. Verizon did. In the long run, shareholders were better off with bid B. In the short run, probably bid A.
But in a market economy, aren't shareholders allowed to decide what's in their best interest?
Yes, but you've got to define the shareholder. I would argue that the shareholder who take this Quest, Verizon, MCI transaction, the shareholder who buys all that stock in MCI just to see it go to Quest, and at the same time is short, let's say, Quest on the other side, or has hedged it out, is not really a shareholder because he has no risk. To be a shareholder, you should have risk. And I would argue to be a shareholder really, in a more ethical point of view, from a more ethical point of view, is you should have a longer-term view of the corporation. The corporation shouldn't exist for the next 30 days.
But how do you take that theory and apply it in practice? I mean, how could we possibly distinguish between individual shareholders and their rights?
Well, one way you might do it is say the people that are entitled to the vote are the people that have been shareholders for the last 3 months, 6 months.
Pick a time frame.
You take your time frame. But not somebody who came in yesterday and is going to be out tomorrow. That person doesn't have a real sense of the company. And yet index funds have to be there forever. They certainly have to be involved.
The hedge funds, I think, are sort of some of the most interesting new players because they are coming in, they have tons of money. They don't have $1 trillion, exactly. And they don't have the same investment goals, shall we say, as someone who's sitting at home with their stock that they bought and they've held on to it for 30 years. Does the regulatory system address this adequately? No. Are there proposals on the table that are worth looking at?
I have never seen a good proposal on that. My proposal would always be disclosure. I wouldn't mind having a hedge fund active if the hedge fund disclosed they were really not at risk in this sense, that they were hedged off somewhere else. Once full disclosure is made, I can't debate it very well. But as somebody once told me, I never heard a good defense against disclosure.
It seems to me we're in the midst of we're sort of at a key point in time where there are forces arguing for more regulation, there are forces arguing for more deregulation, and there's sort of a tussle going on right now area. And if you look at Donaldson's resignation, I think it's very much a reflection of that battle that's going on. Where do you stand on that battle?
I think there are places where we need more and places where we need less. I would say on Section 404, we could probably use a little relaxation of the regulation. I would think hedge funds at a certain size ought to be regulated. They're investors like anybody else. I think their activities ought to be regulated. I would like to know, as part of this regulation, do hedge funds ever act in tandem with one another? Subject I would love to investigate.
And is that legal?
No, not unless you disclose.
So that would be an issue, whether they're doing it and not disclosing.
Yeah. So I would say there's no one rule about regulation, deregulation. There are places yes, places no.
When I think about these trials, to the extent that some of the CEOs, as you say, there may be some hung juries, there may be some acquittals, do you feel that that will damage the outlook of investors in the capital markets? Do you feel that confidence has been restored?
I don't know that confidence has been fully restored. I think if there are some acquittals in some of these cases, people are going to be really disgusted by it because it's so outrageous. I would hope the juries would own up to their responsibilities. I just think it's too easy to see the right things at moments like this. You can't look at what happened in the Tycos and the Enrons and the WorldComs and the Health Souths and not understand that there was a whole underpinning of fraud, misstatement, cooking the books. Nobody would argue that. And even the people that are pretending to be innocent agree that there was fraud in the company, but everybody points to somebody else and says it was their fraud, not my fraud. But it's been my experience, and God, I've been in the business 45 years, that when there's fraud, by and large, if it's massive, the top knows.
But you can't convict on that basis.
You can't convict on that basis. But that's why I would say, unless the top shows some inclination to do a little work and a little due diligence, I would hold them responsible.
There was a recent turnover of the decision involving Arthur Anderson, and it really revolved around the directions that were given, the instructions that were given by the judge to the jury. Do you feel that the juries can actually understand these issues given how technical they are? And I mean, is that part of the problem?
I think that is part of it. It's a very difficult issue. You start to hear the jargon of business and you hear 32 charges of fraud and misstatement, and you hear months of testimony. It is enormously complex. I don't know that anybody can handle that much before your attention wavers. So I have some sympathy for the juries.
Well, I think that if we had CEOs who were honorable in the first place and not interested in presiding over companies where these kinds of massive frauds were taking place, we wouldn't have gotten into this problem to begin with. How did we end up with so many rotten apples at the top?
It's interesting. I don't think we started with rotten apples at the top. I believe in the slippery slope. I believe most CEOs get to their positions by doing a good job, being competent, and they get to a place of authority, and then they start to slip on their ethics a little bit because, number one, their compensation is tied to short-term rewards. The stock has got to be up. In the Enron case, the stock had to be up. It was the underpinning of the whole company. Everything was pledged against that stock, and if the stock started to fall beyond a certain number, there was massive dilution. It was chaos if the stock fell below that number. And when you get to the point where the stock has to be up, well, what keeps the stock up but the earnings? And so the next thing you know, you're compromising a little on the earnings. You're supposed to earn 38 cents for the quarter per share, 38 cents per share for the quarter on that particular company, and it comes in at 36. And you know Wall Street's going to be disappointed and the stock's going to go down, so you find 2 cents somewhere. And the next quarter, you not only have to find that 2 cents, but you got to find another 2 cents somewhere else. Now you're on the slippery slope, and you're covering up and covering up and covering up. I don't know if you remember the Barings case in Singapore, where some trader started to trade around a position. He was losing money. He wanted to cover it up. By the time he was done, he was down $1.3 billion, and Barings Bank was out of business.
That's a heck of a slippery slope.
That's a slippery slope.
We've been fortunate to have Larry Zicklin, the former chairman of the board of the investment firm Neuberger Berman, as our guest today. Thanks, Larry, for being on the show.
Thank you, Sarah.
Some people think of New York as the world's second home. The City University of New York, With students coming from 90 countries and speaking more than 155 languages, is the world's first university. Find us on the web at cuny.edu or call us at 1-800-CUNY-YES.
Why is it that some of the greatest champions of our market economy are the least willing to accept one of its core principles? The notion that there should be a strong link between risk and reward has been a cornerstone of capitalism since its inception. Yet, as we have seen, many CEOs, the most prominent leaders of our business community, seem to think there's nothing inconsistent about basking in the stock options and bonuses when things are going well, but averting serious penalties when things go wrong. The Sarbanes-Oxley legislation passed by Congress in the wake of the Enron debacle did much to make CEOs and directors more accountable. But the further we recede from the crisis that triggered that legislation, the greater the pressure to dilute those reforms. William Donaldson, who has chaired the Securities and Exchange Commission these last few years, tried hard to stand firm against that pressure, but he has now been successfully hounded out of office. The battle is intensely political, and those who want to turn the clock back to pre-Enron days are winning. The only way that will be reversed is if those who seek to restore that crucial link between risk and reward make their voices heard. There's no time like the present. For USA Inc., I'm Sarah Bartlett.